Welcome back to another episode of Fun Friday with a special guest, someone who's got a lot of energy. So this is going to be a very fun conversation and talking about something that no one has actually came on this channel to talk about, a alternative sponsor, something that's a little bit different than my own end. And he's got great perspectives because he's had a pretty robust career already. He's a young guy as well, but is accomplishing a ton. He figured out a great niche. So I'm super stoked to share this guest with you. Gregg Gruehl, founder of Gruehl Capital Management. Did I get that correct?
You did. Thanks, Craig.
Good.
Appreciate being on the show, the opportunity.
Yeah, absolutely. Well, let's get into your origin story, kind of your background, and how you got to where you're the founder of a very, very cool company there in Ohio.
Yeah, so it's a long story. It's been a long tenure. You can date it all, real estate, all the way back to our great grandmother, where she was actually a licensed broker in the state of Ohio in 1942 while her husband was off fighting in World War II and ultimately passed over there. My grandma my great grandma then passed it on to my grandfather, who then went on to my dad, who was really the biggest influence in my life. I don't even know that I met my great grandmother. So effectively, he was a broker for his entire career, over 40 years as a retail broker, focusing on out parcel development and basically single use grocer sites, primarily with Aldi there at the end. But really, I kind of approached real estate. I was playing hockey my whole life. My dad hands me Rich Dad Poor Dad at 18. I went on to play junior hockey, so I just read books and played hockey and had a good time like anyone does between 18 and 21. But basically, when I read Rich Dad Poor Dad, I was like, all right, I'm going to study finance once I do eventually go to school. Didn't Knew I didn't want to be a broker because all through high school was the 0809 great financial crisis, and seeing my dad's ups and downs. I was like, I need to have some more steady income, or what I believed was more steady income. So I'm going to go work for the principal side. So right out of school, graduated from Ohio State, then went into work for a company named DDR, which was formerly one of the largest shopping center owners in the country. I was in their management trainee program, rotating through different roles there. Ultimately, they had a restructuring while I was there, so that's really fun to go through 10 months into your career. I ultimately wasn't restructured. They offered me a full time role at pennies on the dollar compared to who they just let go. But as a young guy, everybody just knew got fired. That wasn't exactly an
Welcome
advantageous.
to the real world.
Right, right.
Yeah.
Yeah, no. They're like,
Fresh
yeah,
out of
move to.
college to, the worst economy we've had since, God, maybe the 90s or something like that,
Yeah,
80s when, there was
it,
that, issue in the Gulf and such, right?
right. And honestly, they were like, hey, you're in Ohio. Let's move you to downtown Chicago to cover our downtown assets, and we're only going to pay you $5,000 more and a 10% bonus. So the cost of living differential, just so you know, is almost double if moving to downtown Chicago at that
Nice.
time. So I'm like, okay, cool. I'm going to make $5,000 more. Great. That sounds awesome. No, so ultimately didn't take that role. Went on to work for a multifamily firm, which you guys cover most multifamily firms on a daily basis on your pod. And worked in asset management. They did a lot of student housing. So in asset management, that's all about pre-leasing and going through the year and trying to lease up the site each year. Um, didn't found that particularly to be my niche. Same with retail. But luckily, my wife actually saved me there because she moved us out to the West Coast for a job she took out there to California. And that's ultimately where I found the asset class that I love, which was industrial real estate. I just so happened to land at one of the most well-founded or well-funded startups. So Blackstone was deciding to get back into the industrial space. They had just bought about 80 million square feet via a couple of different portfolios. So they were building out a team, and I happened to be employee number 18 there, number 3 on the West Coast, in the asset management department, doing the leasing and overseeing valuations for that portfolio on the West Coast. Fast forward, I spent 3 years there. It became Link Logistics, which is the second largest owner in North America behind Prologis and in the industrial space, where I did a substantial amount of leasing volume. I mean, their portfolio went from roughly an $8 billion valuation to almost 40, maybe even above 40, depending on who you talk to at the peak. So, Blackstone's all in bet on industrial. I mean, it's their largest platform company. So it was a great experience to be there and really during the boom of COVID and see the leasing. Like there was a February where I did 28 leases in 28 days. So pretty exciting when you're talking about big leases worth millions of dollars. So pretty good stuff. But
And
COVID
also,
also,
by the way, and you said that was during kind of COVID, so that was during 2020, 2021. You were doing with Blackstone. Is that correct?
yeah. So I started there in the end of 18. They bought the biggest portfolio they bought at the time was GLP, which was a 180 million square foot portfolio that they had actually sold to GLP, which is the sovereign wealth fund of Singapore, for 9 billion. They bought it back for 18 billion. I think that portfolio probably, if you value that out, is probably worth high 20s, maybe even 30 of the portfolio today. So basic, and they've sold some of it off, obviously. But yeah, it was a great time, and COVID really caused a boom in industrial real estate in
Well, for
that.
sure, because retail was historically all really brick and mortar. Obviously,
Right.
Amazon Prime had kind of been coming into it, which is obviously very
Hmm.
creative for what you're doing there, right?
Right.
But,
Right.
retail at that point, you couldn't really go into stores. So, for the better or worse, like it or not, the behemoths got richer and, the kind of mom and pop groups kind of got shrunk there. But
Yep.
where do those places go? Well, they need to warehouse and store stuff, right?
Right. So what you saw during COVID was actually, so e-commerce today is 16% of retail sales in America. What you saw during COVID was the long run trajectory was obviously up and to the right for e-commerce. But what happened was that bounced actually to something like 40% for a while because you couldn't go into the store, like you just mentioned. And so Amazon took down hundreds of millions of square feet throughout the country. I mean, if you leased a building to Amazon, it was as good as gold. So
Pretty reputable
it,
tenant, last I checked.
yeah, last I
Yeah.
checked, yes. But
That's a grade A tenant.
honestly, yeah, grade A tenant, I would tell you now it's a little tougher because what happened when the Fed raised rates in 22 is at the same time Amazon said they were going to give back space. So that just like decimated the belief in the market, right? On Amazon, it kind of soured everybody on Amazon because they were strong arming people, kind of like Walmart did on retail leases forever. So effectively, they drove the market, and honestly, there was a ton of speculative development based on that over that kind of period. So you saw a boom in it, a massive boom in rents in that time period. But during COVID, I will say, yeah, it was all great on the work front, but in the home front, I actually the week that offices were all shut down, my wife found out she was pregnant with our first child, and
No
so we're
stress.
in no stress at all. We're in 650 square feet. Can't go to the beach. Can't even go outside. Everybody's worried about everything, right? And so my wife and I are working. We're both, both working. Fast forward a few months, obviously have our son out there, and I'm standing in a non-walk-in closet making phone calls about tenants not wanting to pay their rent, while my wife's in the living room, 10 feet from me, holding our son, trying to have him sleep while she's on the phone with a customer needing PPE equipment. So so it was a lot of stress, right? So that's what kind of drove me back to wanting to go back to the Midwest, where there's friends and family, you can get out of the house, all those kinds of things. So ultimately at Link, I was in asset management and leasing. I really wanted to kind of round out the Rolodex, wanted to go into acquisitions. So what I, made a few phone calls to my network here in Columbus, Ohio, and said, what's available. And Stag Industrial had an acquisitions role to oversee part of the Midwest and then part of the Mid Atlantic for acquisitions. And I was like, this is great. So I had a job pretty much instantaneously. And Stag Industrial is another large shop. They're not Link or Prologis large, but they are one of the largest public REITs in the industrial space with over 120 million square feet in their portfolio. Was lucky enough to do about $300 million worth of transactions in the 3 years I was there. I will say that sounds like a big figure, but it's not very many deals. In that, one of the deals was $140 million. So, just to give you a scale. Now, Stag pre Fed interest rates was set up to do 70 or so deals a year. That shrunk down to 20. They were staffed for 70 or so deals. So ultimately, that's why we parted ways after my 3 year tenure there. So, that was a little bit of a turmoil part for me, but I will tell you honestly, it's onwards and upwards. And I was starting the entrepreneurial grind, laid off on a Friday, started the business on a Monday.
Right. So how many years deep now are you in the company for
So
your company?
this company is only actually 7 months old now.
Yeah. And you guys are up to a lot already, which is super cool. But it seemed like kind of your trajectory and background was kind of perfectly forged. But I almost feel like you reverse engineered things there because I don't feel as if I just couldn't see you in an asset management role. Maybe my perception of asset management's not perhaps what you were doing there before, because it sounds like you're doing some sales, leasing and whatnot, and kind of working with vendors and whatnot. But
Hmm.
I can't see you in that position. I could see you kind of almost living a false life of what your purpose is, which is probably selling and kind of doing acquisitions and kind of being really entrepreneurial as opposed to being an employee. But I would argue maybe the counterpoint to that is to kind of shape your future. You kind of almost had to see the big kind of box corporate style of stuff to kind of put your own twang and branding and kind of get the MBA of sorts, if you will, of doing it real and live as opposed to learning from a book and then doing it that way. Is that fair?
Yeah, that's fair. What I would tell you about my asset management role, like, do I love did I love like quarterly valuations and that stuff, or dealing with oversight of property management? No, that wasn't really my forte. In the link role, it was primarily became a leasing role. And my favorite thing about that job was negotiating leases, right? You have 5 deal points that you can pull a lever on to get a tenant to accept your deal, whether that's the face rent, a free rent, abatements, tenant improvements, term, or rental escalations, right? So you just kind of manipulate those to make sure that you still get that value that you budgeted one way or the other effectively. So that's where my juices got flowing in that business, because I am more of an outgoing salesy person.
Yeah, that makes a lot more sense now, and now that I'm
Yeah.
analyzing that, because I just perhaps just having the conversations we've had together, I just can't seeing you, in a position doing anything what you're doing right now, perhaps. So
Yeah, no. So I will tell you, from the time I was 18 on, it was like when I read Rich Dad Poor Dad, that was kind of the start of it. I've read hundreds of financial books, but the reality of what it is for me is I am highly analytical, believe it or not. But I am also I was kind of reverse engineering which roles I took when. Now, maybe not the DDR role at first, because I needed money, as any college graduate does.
yeah,
But I did see the light at the end of the tunnel, because the rotational program, most of those people were becoming like senior management of the company very quickly. So that was kind of where that idea was. But ultimately, thereafter, it was strategic to understand more parts of the business from an institutional side. So someday, didn't know when that was going to be, that I could do exactly what we're doing today.
yeah.
Pieced it together.
Yeah, so let's talk exactly about your product type is what you do. What exactly, how would you explain to someone who perhaps has no knowledge of industrial real estate, no knowledge of, really much other than, oh, you buy homes, there's apartments. How would you, in the simplest terms, describe your product type?
Well, when I first started at Link, I was the easiest way to understand industrial is this: it is 4 walls and a roof in a rectangle shape primarily,
And
and
you have
you're
a
typically
lease.
and you have a lease in place with a business, so it's business to business. That's one of the things that also intrigued me versus multifamily, because that's business to consumer. The negotiations really aren't per se negotiations on the leasing side, and that's really where I wanted to be in. But yeah, industrial real estate more or less is a box where everybody's stuff goes and then it gets distributed from it, right? If you're dumbing it all the way down with a lease in place. The beauty of the simplicity of the leases, they're typically triple net, where in multifamily, they're more or less call it, gross, right? Because, or not, so you're dealing with expense overheads that aren't 100% controllable on triple net, well, or on multifamily, where in the industrial space, they're triple net. So any changes, fluctuations in those expenses are put back to the tenant as they're required to pay them.
Yeah, and just to explain it to people, so imagine multifamily, right? You've got, for Lone Star Capital, the minimum property that we're going to buy likely is probably no less right now than 200 doors, right? So that is 200 roofs, 200 toilets, probably more than 200 toilets, showers, but you get the idea. 200 toilets, 200, rooms, whatever you want to call it. And it's a lot of people going in and out, and it's not, the person is the grantor there, as opposed to the triple net world. We'll just go there. That's like a Safeway, that's an Albertsons, that's a Whole Foods, that's
Mm-hmm.
a Dick's Sporting Goods. That is a tenant there. So similarly, what
Right.
you do in the industrial world, what Gregg does is he essentially gets that kind of structural setup. He gets a warehouse like thing, and tenants come in there and they sign Leases, we'll talk about that, the extent of it,
Hmm.
how it works with kind of increases, but they sign a longer term lease as opposed to, the transient community base of an Austin, Texas, or Bay Area or
Hmm.
Los Angeles, where, hey, you're there, you're looking for a rent, it's maybe 6 months, it's a year, if there's concessions potentially, people can kind of violate it, they cannot pay, whatever. Totally different world than what Gregg does with regard to leasing. So if you can kind of break down the typical standard lease, that what you're looking for, what you've done, and
Hmm.
kind of in simple terms would be awesome.
Yeah, so simplest terms on leasing. So as we already talked about expense pass-throughs. Now, a typical industrial lease, let's say the building's 100,000 square feet. For simplicity, let's say it's a single tenant building. You probably are only dealing with 5 or 6 toilets, but again, that's on the tenant. And only one roof. But effect more or less, you put this lease in place. It's usually, I would say, you can see as short as 3 years, but their most typical term is between 5 and 10 years. Leases are in place. Now, where it differs from retail is retail, you typically see a larger bump at year 5, call it like a 10% bump. Whereas the beautiful part of industrial and why institutions love industrial is now kind of the market minimum is 3% escalations each year. And on the West Coast, you'll see 4 and 5%. Even some markets throughout the whole country, you'll see 4% escalations on their rent. So if they're paying you $1,000, you're going to get $1,004 the next year per month, right? So like you're growing that rent, then that's a small number, obviously, but your rents on 100,000 square feet here, and let's just use Columbus as the example, on 100,000 square feet are probably $9-ish, give or take, per square foot. And that's on an annual basis. So yeah, and they're locked into that for 3 to 10 years, call it. Option periods, because the vacancy rates throughout the market are not as common, and if you do give an option, it's usually fair market value. So you're really just resetting the market anyways. So it's just really so that it's more so protection for the tenant, so that they don't feel like you can boot them out for a different tenant.
Makes sense. Cool. So, where do you come into play then? Like, what is your angle? Do you develop? Do you do value add plays? What are you kind of looking for? What's kind of the thesis of your capital management company?
So our initial thesis is completely different than what it is today. So we initially were like, okay, let's democratize stabilized buildings. Let's bring sub-institutional class industrial to the masses of syndicated investors where, they're seeing a ton of multifamily deals, but they're not necessarily seeing industrial. Okay, great. Let's start underwriting. So we started underwriting, and we just found that the returns were super low for anything marketed. So we had to, throw in low prices, or pricing because of debt was too tight. So call it, a 10% IRR, 12% IRR at best on a stabilized deal. Now, granted, the difference here in multifamily is your expected return is likely higher, in that you have your 3 to 10 year lease in place with a company that's unlikely to go out of business in that time. So you're kind of hedged against the need for higher returns because you're getting that cash flow more or less. You don't have to deal with the asset as often. Now, that's great, but as a new firm trying to raise capital, that was very challenging because you don't really draw anybody's eyes to a 10 to 12 IRR type deal, right? So then we kind of iterated through doing some value add, which in the industrial world, most of the time tenants get what's called a tenant improvement allowance. So the buildings are typically spruced up every time you're changing the lease on who the tenant is. So you're not really getting like a rent bump for improving the building, unless you're raising the roof, expanding the building, maybe adding docks, improving the lighting. But some of that stuff's also typically included in tenant improvements. The one big value add is expanding the building or adding trailer parking, so industrial outside storage, which is also another hot asset class as well. So that's just another revenue stream. The other thing you could do is ESG play by adding solar to the roof, but you need a minimum building size of about 80,000 square feet for that. So we went down that road, and the returns are better, but we were trying to buy them from institutional sellers. And since we're a new group on the shop, we took our lumps, even though we were the highest bidder, and they kind of passed on
Certainty of
us on a best of
closing
five.
is kind of, yeah, probably now more than ever with the rate environment, it was probably the most important thing, as opposed to when rates were kind of going gangbusters, the market was appreciating. Fine, if you don't close, we'll take your earnest money deposit. You can probably raise the capital. Now you probably can't raise the capital, or so they thought, right? Fine,
Right.
hey, no
Yeah.
problem. You know what? If you don't want to raise or perform to close, we'll just follow the contract. We'll eat your money, and then we'll sell it to a higher price, and it's all good, right? That was the mindset
Yes.
before. Now it's all about
100%.
certainty of close. And that's kind of unanimous throughout any business right now, any real estate transaction.
Right. So as a new shop, we're like, how do we overcome this? So one of the ways on that specific deal where we lost out, I mean, I offered to go hard on 100 grand of my own capital that day if they accepted the LOI. So, and I did
That's a
ultimately
gut
find,
check, by the way, as an entrepreneur.
oh, yeah, absolutely. I was
With,
willing to
with
take the
babies
risk.
and a family and stuff.
Yeah, absolutely. Yeah, I mean, I have a daughter as well. So like we were ready to pull the trigger. My wife, when I told her, she was like, "All right, let's go, strap in, baby."
Yeah.
So you know but honestly, that's what you got to do as an entrepreneur. Like you got to put yourself on the line. And I will tell you that was the greatest move, even though we didn't get the deal, because we found several partners that would have funded that deal had they known about it earlier. Had I known that prior, I would have offered going in with them on a joint venture agreement. The thing is, you know, in this world where those guys already operate industrial businesses and we don't have solid partnerships, I wasn't going to trust to send anybody a deal at that point. So that's why it kind of worked out that way. Now the people I called and had sent the deal models to try and rectify this or reconcile this deal and get it off the ground with the seller, you know, they were all like, "This is great. We would love to partner with you. We believe in how you underwrite and look at deals." So it was a win lose, but it was ultimately a win win for our firm. Now, all the while, we're like, all right, what's the other way to move past the surety of close execution risk part from the institutions, where I know all these people. Like I knew this seller, and they still didn't operate that way. So basically, we figured out that ground up development was going to be our best play. Now, the big box leasing space, which we were kind of talking about with Amazon, has dried up, and a lot of development has basically, you know, there's not a whole lot of new starts when you're talking about above 300,000 square foot buildings. Even all across the country, there's a ton of vacancy that has ticked up in that size range. So, like, all right, what can we build today that makes sense? Well, our niche that we've kind of landed on is sub 100,000 square feet. And not even just leasing it to one tenant for 100,000 square feet, it's more so chopping that building up into sub 30,000 square foot units because the vacancy rate in, for example, Columbus or most markets throughout the Midwest is sub 3% and in some cases sub 2% on that suite size range, not the
And
building size range.
yeah, so what would you say the benefit is of kind of breaking up the tenants if occupancy is high? Is it just basically because if these tenants turn over at different periods of time, it's not kind of a binary one or zero, all or nothing equation there? What
Mhm.
is kind of the thought there? Or if one kind of goes down, hey, you've got, 75% lease, like why not, kind of do it that way out of curiosity?
So one of the biggest driving factors I will tell you, yes, every one of your points is valid. Staggered leasing, right? That's great. But what I will
Particularly in
ultimately,
office triple net world too, by the way. Like if you
yeah,
have one tenant there and they're gone, well then you're 0%. It's kind of the same premise as to why people like multifamily, duplexes, triplexes, fourplexes, as opposed to buying single family homes because,
right.
well, one person's gone, then there's no money coming in.
Well, so here's a couple ways we look at this. So chopping up the building into, let's say it's 100,000 square feet in Columbus. I told you it was roughly $9. I don't know exactly where it is because I don't play in that
Tomato,
leasing arena
tomato. Yeah,
typically.
yeah. Same
Yeah,
range.
yeah.
Yeah.
Now your range on 10 to 30,000 square foot suites might be 11, $12 a square foot. Now, the big key there, and the reason that matters, is imagine getting $12 a foot on 100,000 square feet or $9, and then knowing what you know about dispositions, apply your cap rate to that. That pricing is massive, millions of dollars different on the exit, millions. Maybe even on 100,000 square feet, that might be five, six, $7 million in
Or even
value.
better on a refi, right? Getting bucks back on your end.
Correct. And then you're also hedged in that you have multiple tenants. Now, I will tell you the credit plays in there. So maybe the 100,000 square foot tenant's a little bit more credit worthy. The other thing you do in industrial to kind of hedge if you want to do the single tenant is you're going to have it filled quicker. So your cash in development, your cash flows are starting quicker. But also the other thing is industrial, you always underwrite downtime, right? So the typical underwriting of a deal is, a 5-year lease. We'll do 60 months, right? With, 1 month free. And depending on the current market conditions, you're going to do somewhere between 6 and 12 months of pure downtime in that before you're leasing it up. Now, so that's kind of how you hedge out like, hey, in year 5 that I have 6, if I put 12 in there and you're saying the renewal probability is 50-50, let's just say for simplicity, that means I have 6 months where we're not expecting cash flow in this lease or in this building. Now, the beauty of that, that's all priced into my return assumptions for the investors. So that is how you're hedging that. That is the beauty of multifamily is that, yes, you're probably, if you have a good product, you're probably not going below 85, 90% in some cases, maybe even below 95% leased at any given time, unless it's
Well,
on
if you're above
purpose.
95%, you're priced too low. If you're,
Right, you got to push
call
it.
it, I would say right now 88% is actually fair depending on the market that you're
Okay.
in, just with a lot of the absorption going on. But I would say 90 to 95% is a sweet spot. 93 to 95, you're doing something right. That's kind of the world that we're in.
Right, and you're operating with revenue management software that's ticking your rates to keep those occupancy rates, correct?
Right. Well, you can get a little in trouble with that. That's what a big operator that will go nameless actually had trouble with. But yeah, I mean, pricing should be dynamic, and there's an elasticity play there for sure.
Right, for sure, for sure. So yeah, I mean, ultimately, you price those things in to the investors, though, in our world, just because there's going to be some lump in there. And then, to be honest with you, that's the beauty of it over performance in industrial. I underwrite 6 months, the tenant renews. That underwriting, just that IRR that I originally gave you, is just blown out of the water just by one renewal being signed.
Right.
Right, and then the potential for, if I give low market rent growth over that 5 year period while they're in there, they might be renewing at a substantially higher rate. So then you're further exacerbating that with no downtime, no new tenant improvement, lower leasing commissions. So all these things, like if you get a renewal, it's substantial.
Yeah, and that's
Um,
it's funny you talk about renewal in your world, right? Because similarly, what people sleep on and the importance of a renewal in our world as well, because then the team doesn't have to go in there to paint. There's not a make ready. There's not a down
for
unit.
sure.
So a renewing tenant, even at the same price on the rent bump, is so valuable. So,
Hmm.
and that's why the importance and emphasis on asset management teams and stuff like that, property management teams, the on-site management teams is so crucial for a property doing well, and people kind of sleep on that kind of thought there. So
100%.
on your end as well, what's the typical lease length as well that you're kind of looking for? Are you looking for a 5 year, 10 year? What does that look like?
So when I underwrite, it's almost always five. A lot of times, newer buildings, bigger buildings, you'll see 8 to 10 year leases. You don't typically get into those shorter 3 years unless they're a renewal of 3 years from an initial 5 year term. Now, I will tell you, during the boom, a COVID boom in rents, out in California, landlords like Link and Prologis were pushing shorter leases because rent was growing astronomically. I didn't track it, but you're talking maybe even doubling within just 2 years, right? And some of the most expensive rents in the entire country, doubling, right? So they wanted shorter term to capture those rent growth, and they weren't willing to give like minimum options or any of that kind of stuff, because really now, but we are now seeing some of that roll back in SoCal. I can't give you exact figures, but basically SoCal rents are almost going slightly backwards because of that exact thing. It grew
Well, there's a
so
bit. Well,
fast.
there's a massive building boom, right? So, kind of interestingly enough, there was undersupply. Obviously, things got crazy, immigration. More kind of businesses, more just kind of
Right.
a big cultural shift from in-store retail to Amazon warehousing, last mile stuff. Then it got built, and then now what you're kind of seeing, similar to everything else, is either pricing stays stagnant or come down, and in certain
Hmm.
pockets. Is that correct?
Yeah, and which is why we're actually targeting that smaller segment, right? Because I want to target where there's almost no vacancy. So, for example, Columbus's headline vacancy rate right now is almost 8%. Now, Big Lots, who just filed for bankruptcy, they just vacated 3 million square feet. Okay, so that shifts a market. That's almost, I think, almost 100 basis points of the vacancy rate right there,
But you're
right?
playing a different space, right? So who looks
Correct.
at that, I
So
imagine, is like the Amazons, the Walmarts, the big stores. They'll get that say, okay, well, let's change my lease or maybe amend it perhaps. I don't know if that's allowed, but maybe when they come in for a new lease, they can kind of leverage that as opposed to smaller tenants. There's not as many spaces to go. Is that correct?
they definitely have some leverage, those bigger box spaces. Um, Basically, the idea is for like those guys, there is some vacancy in the market. Keep using Columbus. Now, what I will tell you is, as of late, really since the turn of the new year, and talking to the brokerage community here in Columbus, there are a ton of brokers running around with bigger tenants, tenant requirements to take down space. So a lot of that tenant friendly market is kind of converting. Now, again, we don't really play in that. We're playing in the smaller mom and pop business or an Amazon third party partner, right? Because, I was just reading this morning that 60% of Amazon's actual units filled are by third party partners that fulfill them themselves. So basically, think about all those people that need warehousing space. I mean, I saw it a ton in SoCal, where it was an Asian supplier of something that was sold on Amazon, and they need 20,000 square feet. They're not a credit tenant, right? Like that's kind of who you're serving is
But they
like
still have a
the
good product. They're still moving it, but they
correct.
need a home for it, right?
Right, exactly. I mean, and that's anything. I mean, from just to give people an idea of the tenant base. Sorry, I didn't do this earlier, but basically, I mean, I've been in warehouses that manufacture nails, manufacture SpaceX rockets, um, imitation crab meat that's in everybody's crab rangoon. Sorry if I ruined that for you, but worst warehouse I've ever been in.
I'm
I've
sure it
seen
smelled
Sunny.
great.
Oh, it was wonderful. Hot
Yeah.
fish.
Yeah.
Sunny
Yum.
Delight Manufacturing. I will never drink high fructose corn syrup after that one. But basically, it's, it runs the gambit of the American industry, right? It's the GDP. Like, I don't remember the exact figures, but Link and Prologis will publish these all every so often. It's like they'll publish, oh, X percent of Christmas sales went through one of Prologis's warehouses, and it's a large percent. So you realize that it's anything and everything. The shirt I'm wearing, the desk, the computer, everything has gone through a warehouse at some point, right? And that's not to even mention the connection we're going through is through a data center, which is also kind of like a quasi spinoff of the industrial market. And they're eating up good industrial sites, which is also going to further help push kind of empower. So it kind of pushes industrial users to find different spaces to utilize. So there's a bunch of synergies where industrial operates in your life, but most people don't understand that Amazon and Walmart don't own their distribution centers.
Well, people are not going to stop buying stuff, and people aren't going to stop needing a place to live, which is kind of the thesis behind what we do at Lone Star and what you do, obviously,
Right.
with your company. Is if this is a unreplaceable kind of item where AI can't really disrupt it,
Mm-hmm.
that's great because it's not
Right.
like things are going to be developed in there and then sent directly to the consumer. It just doesn't work
Right.
that way. Like there's
No.
there's a there's a logistical sorting system that is involved here, and Columbus is blowing up, obviously, so it's probably a very
Mm-hmm.
very good market to be playing in.
Yeah, Columbus. So we've kind of talked about our geographic. We haven't kind of touched there, but basically we're operating mostly on Ohio deals. We still see some from my residual networks in Virginia and Kentucky. We also see some stuff out in California that I have access to through my relationships from my time at Link. But yeah, I mean the markets are solid for growth, primed for growth, right? Multifamily, you have heads and beds, right? In industrial, we have all your goods that are going there, including the bed,
Yeah.
right? And then the other one is the other real asset class that's not going to go away is data centers,
No,
right?
that's I mean
Because
that's an emerging sector for sure.
right, right, and that's going to be an even harder one to get syndicated capital into, just because the dollar figures and the operations are so heavily specialized,
Right.
right? So, and that's the one thing about industrial, it's kind of on the edge of that, is that it's kind of kept people out because you don't have an access to the data. You like apartments.com has your rent figures if you really want to utilize that as your source, right? At a bare minimum, right? Most people can get into residential, go buy a house, buy a duplex, buy a quad, buy an 8,
It's a lot
buy
more
a 16.
straightforward. I mean, anyone
Right,
with kind of a brain can look online. They can go to Zillow. They can go to apartments.com. They can go to Redfin and just say, what's this renting for roughly? Okay, well, my house is this and that spec. Okay, cool. This
right.
is the price. If it rents right away, great. If it doesn't, you move the price, so on and so forth.
And here's my cash on cash return. And here's what I think if I flip it,
Very
it's going to
easy to
be.
calculate.
It's back in the napkin. We actually do it on the other side of our business, for a cash flow business, right? For me, this is, I mean, people's head would spin if they saw the model that I have going. So yeah, I mean, and the truth is, like, it takes a lot more of a heavy lift of data that an individual who has no background or history in it, go call the broker and try to get the right information from them. Well, they're going to give their institutional clients the best sites, the best locations,
Yeah,
the
people go
best
where the bread's
tenants,
buttered.
right? And they're making all their money, right? They're going to give them all the best information and research. You're going to get the second-hand scraps. And so honestly, there's not a ton of way for somebody who's just like, I have 100 grand. I really would love to invest in industrial. There's really not like a big way to do that, because it's typically family offices, private wealth, ultra high net worth, funds, private equity,
Yeah,
public shops.
institutions. Yeah, I mean,
Yeah.
it's a lot
So,
more. It's a lot more complicated, and it's not on top of mind, but everyone knows someone, or everyone at some point lived in an apartment, likely, or a
right.
townhome, something of that nature, right? In most
Yeah.
instances. People have homes. These are very easy things to understand. It's kind of not the front of mind to also be on the industrial side of things, which is probably a value, maybe why returns are slightly greater. But on top of that, you really have to be an expert. And we're talking about a very niche sector within real estate. Real estate's obviously so broad, but this is something you have to probably be in brokerage on, or be at an institution, be on the equity side or the principal side of things at kind of a big, corporation side of things to actually have any sort of understanding of this said asset type and product. This is not something that's as intuitive as the rich dad, poor dad, cool, liability, asset column, awesome, I'm going to
Right.
buy a house
Yeah.
and it's going to pay for itself and yada, yada. This is something that's
Right.
a lot more dynamic and robust, which is probably good, which kind of brings me to the point of returns. So in
Yep.
multifamily, right, I can only really speak to that because that's what I know best. You're looking at probably somewhere between, depending on the, let's just say for value add, not development, totally different ballgame, right? But on the value
Yep.
add side, if you're doing core plus, you're looking at a 10 to 12% return, maybe 14 if things go gangbusters, but you're probably not projecting a 14 on core plus. But
Right.
let's call it
Right.
a 10 to a 18% IRR is typically standard in the multifamily world.
Yeah.
And some of that will come by way of cash flow. Call it, let's say 5 to 6% is cash flow, and the latter would be on appreciation on the back end of sales, hopefully,
Right.
right? What
Right.
are projections when you're talking to investors for your asset type?
Yeah, so the value add deal that recently underwrote, we were looking at, call the range to be like, depending on how we the capital stack, it was somewhere between a 17 and a 20, depending on the leasing scenario, IRR. Your cash on cash, because that had a substantial stable portion, was 6-7%. And it was much higher if you didn't expand the building, but you also didn't expand the valuation on the back end. So that was kind of the driving force there. Development, it really depends on how long you're going to hold it. If you're a 2-year holder, 2.5 year, call it on industrial, you're probably in the 20s, right, on the IRR,
That's
but you're
similar
not
to
getting,
multi. That's actually basically
yeah,
the same as multi, which is pretty
they really
interesting how
are.
dynamic and very interesting how
Yeah.
dynamic pricing is and risk is on development, where
Hmm.
it's basically the similar return.
Yeah, and then honestly, if you talk about developing to hold, like build to core and hold that, you're in the mid-teens. So you're getting a little bit of premium for, stabilizing the building and keeping it. Now, obviously, you throw in the same benefits that multi has with depreciation and all that, and those returns actually are slightly better, but that's dependent on the individual's circumstances, tax circumstances, obviously. So yeah, the returns are kind of the same. It makes sense in the way capital is really circulated and allocated for them to kind of price out the same.
Yeah, markets are
Right.
very efficient.
Yes, yeah, they absolutely are. When you're in them, you realize that they are very efficient, and they price roughly the same. Now, um, you know, we're looking at different return parameters because of different sites and opportunity zones and tax plays, and there's different grants for things and all that can affect returns as well on any given deal. So it may make it lucrative to hold a little bit longer to take advantage of an opportunity zone. You got to hold that for 10 years. Now, that's a big advantage in that those are basically tax free more or less gains, and you are looking at substantially improving your returns because you also will get grants on the front end of that as well to do the development, which is basically a cash flow in a year where you're not going to get lease cash flow. So there's all kinds of different ways to skin the cat, but basically the returns kind of shape out the same way.
Very cool. So with that said, I mean, are you typically syndicating capital? Are you raising retail capital in house? Are you doing basically like a 90-10 agreement where you and your partners will basically put in 10% of the capital and then you'll get an institutional source for the 90%? How are you structuring the deals from a capital perspective, like that formation? And then
Mhm.
similarly, what are you doing from a debt perspective?
Yeah, so what I'll tell you on the equity side is we're kind of all over the map. So on the smaller project, we're planning on syndicating pretty much all of that fund. The other co-GP will bring a large portion of the equity as well. For the bigger 12-acre site that we're looking at right now, that'll probably most likely be majority family office funded, but we will keep a tranche for syndicated funds to really keep going with our thesis, right? Because I do want to raise a syndicated platform to be able to provide that opportunity to investors that they haven't necessarily seen from anybody else in the industrial space. Yes, it takes more education on my part. So if you schedule a call on my time, like I will educate you in the world of industrial, but it takes more education because you haven't seen 50 of these offering memorandums to explain certain things about that deal, right? But I do feel that I love this asset class and I want to share it with more people. And I feel like finding the everyday investor, just the standard accredited investor, not the guy who has $100 million, right? Like the standard guy who might have $50,000 to invest, who has never done an industrial deal. I'm not saying don't invest in multifamily, like definitely invest in multifamily. I'm just saying maybe consider some diversification amongst asset classes.
For
Like
sure.
my main degree area in finance was portfolio management, and diversification is very important. So yes, you can stay in multifamily because it's simpler to understand, but I'm just offering another opportunity for people.
It's exactly why we want to have you here, just to kind of spotlight something that's very lucrative, different ways to make money and different kind of return profile. And we can't raise every dollar, and I wouldn't recommend everyone to put every single dollar with us. Sorry, Rob. Sorry, Kent and team. That's just not really fiscally responsible,
Right.
unfortunately. And that's why we're also looking to expand to Phoenix, Arizona, from acquisitions perspective, and get out of Texas in a sense. Not that we don't want to buy there as well, but these are just additional dollars and additional markets to play into. And it's kind of funny. Neil Bawa, like him or not, has always said that, hey, if you want to actually ironically raise double the amount of money, add a different product type. So, by us
Right.
adding a different product type within, the multifamily world of Phoenix will probably open up the doors of a lot of people who, maybe just don't want to be in Houston for weather risks or Dallas for whatever reason, right? So
Right.
maybe they already have their Texas sponsor. They like us, but, they don't have anyone in Arizona. So it's a perfect fit for us there in
Mm-hmm.
that sense. With that said, when you kind of look at the world right now as we move forward, what is like a perfect deal for you and the team from that perspective? Like what is an ideal setup? Would you develop? Would you do a value add play? Would it be maybe a mix? What is your kind of 2025 goal from an acquisition front?
Yeah, so right now that's purely focused on development. We have, call it 20 or so land sites up in the air on what we're looking at. So we're really more so looking at like what is the ideal development size, and I kind of gave it to you with the sub 100,000 square feet. Now we are looking at that 12-acre site can handle substantially more than that, but there's some comp reasons, so competitive set reasons why that will actually work and has a lot more leeway than some of even the smaller stuff I was talking about prior. That just happens to be a site that's pretty lucrative. But ultimately, our ideal site is, call it between 5 and 10 acres and building between, call it 60 and 100,000 square feet and chopping those buildings up into multiple suites. Probably no less than like a 10,000 square foot suite, but primarily your average is probably 15 to 20,000 square feet.
Very cool. So actually, real quick, kind of one of the questions to wrap up here. Who wears what hat? So you said, is it three partners that have the company that you're running right now? Who wears what hat? How do you guys decide that? Does everyone kind of do different stuff on different days? Does it overlap? Are you specialized in anything? Are you more of the public facing guy, acquisitions guy? Like, how does that get broken up and managed out of curiosity?
Yeah, so it's just two partners. We do have one. We have a third guy who's our employee on our other side of the business. So my brother, he runs our residential business, where we do some flipping and some wholesaling of homes to large flippers and funds that we know. Um, but basically, he primarily wears that hat. I would say 85% of the time that's his focus because that's a lot more volume. There's just a lot more going on a
It's a
day-to-day
lot of a
basis.
lot of moving parts in that world.
A ton, a
Yeah,
ton. So, I would say like 95% of the time, my focus is here on this industrial side, acquisitions, capital raising. But, we really kind of come together when it's financial management. He reviews underwriting. We also utilize a consultant of one of my old coworkers to help with the heavy lift of, checking my assumptions because his background's in institutional underwriting as well. So we kind of we piece the team together via a lot of third party consultants from long standing relationships to really get the ball rolling in different directions. For example, on the development side, I'm not a construction expert. I won't pretend to be. One of our joint venture partners is a construction company, so in project management company. They love that part. They want to handle that part. They want me to handle capital raising, finding sites. They'll also find sites. They want us to bounce back and forth on the leasing decisions. So that's kind of how that's going to go and be going forward. But the beauty of that is for an investor, they know that they are going to have an expert in construction because I'm not going to pretend to be a project manager. I have no prior experience in project management. So I don't want to wear that hat, right? I want somebody who's an expert, who's going to deliver the project on time and on budget, more or less. And then I will, step in on the leasing side and then figure out the capital stack on the back end for the disposition as well. Or if it's a long term hold, I'll handle asset management duties.
makes sense. I had one final question, but it's escaping me. So Kurt's gonna have to work with me here to edit this one. Hi, Kurt. I
No
hope you're doing
worries.
great. Um, oh, it was a good one too. It's escaping me entirely. Cool. We're about to wrap up
No
here.
worries.
Awesome. Well, Greg, you've been such a great guest. Where can people find you to reach out to learn more about your product type, to work with you, invest with you, and kind of get educated in the space that is probably, going to be more popular here for sure coming up in the alt world. But how can people find you, reach out? I know you're getting more active on LinkedIn as we were talking about prior to going live here.
Yeah, so honestly, the easiest way is probably still LinkedIn, actually. So my name, Greg Gruehl, not very hard to find me. Pretty unique last name. I don't think there's more than a couple active users there with that name. So that's probably the easiest way. You can either sign up for my newsletter or just book a call direct with me. I'm happy to take any calls and get to know you, explain the asset class, answer any questions.
Awesome. Well, Greg, thank you so much for being a guest. I look forward to having you on, seeing your success, connecting in the LinkedIn world, and hopefully in a conference here. And for all those who are listening, thank you so much for your time today, and we'll see you next week. Peace.
Thank you, Craig.